Welcome to the deep dive. This is the place where we dig through, mountains of info to find those really useful nuggets so you can feel up to speed fast. Today, we're jumping into a big one. We're trying to simplify something everyone talks about, but honestly, often gets wrong: wealth and financial freedom.
Absolutely. And we've really gone deep on JL Collins' book, The Simple Path to Wealth. Specifically, we're pulling from the 2025 updated audiobook summary. And look, this isn't just about spreadsheets or, stock charts. It's really about changing how you think, giving you practical, like really doable steps to reshape your financial future.
That's it, exactly. Our goal here today is to take decades of investing wisdom, which, interestingly, started as letters from him to his daughter, and just boil it down into a clear, hopefully engaging conversation. Think of this as your shortcut, maybe, to understanding the core ideas that can actually lead you towards, real financial independence. Get ready, because we're going to unpack some pretty profound insights, maybe some surprising facts, too. Okay, so let's unpack this. Collins starts with Chapter 1, A Parable About Wealth. It's interesting, right? He doesn't kick off with budgeting tips or how the market works. He starts with a story, sets a tone.
Yeah, he really does. The parable basically gives us these two characters. You get this super successful financial advisor, huge house, fancy car, everything looks great on the outside. But he's incredibly stressed, always chasing the next deal. And ironically, he feels totally trapped by the very lifestyle his money provides, like a prisoner of his own stuff. And then, in complete contrast, there's this wise monk. Lives super simply, no attachment to material things, but he just radiates this like inner peace and freedom. It's not just a cute story, it's a real challenge to how we usually think about success, about riches. It makes you ask, what are we really chasing when we say we want wealth? Is it just piling up assets? Or is it the life, the freedom that those assets are supposed to give us?
And that leads right into this core idea that he hammers home.
Right.
Freedom over flash.
Exactly.
The story just shows it so clearly. Real wealth isn't about stacking up luxury goods or, showing off how much you can spend. It's not the flashiest car or the biggest house. Collins argues pretty strongly that it's about getting the freedom to choose your life, to make decisions because you want to, because they align with your values, not because you have to financially. And, think about that subtle trap of flash. It's like that, what do they call it? The hedonic treadmill. You buy something cool, you feel good for a second, that little dopamine hit.
Right. Fades fast.
And then it's gone. And you need the next, maybe even bigger, flashier thing to get that feeling back. Or just to keep up appearances. Or, keep up with yourself even. And it's not just buying stuff, it's lifestyle creep too, right? Every time you get a raise, your spending goes up just as much. Or maybe more.
Yeah, insidious.
This chase for flash, it can just be this endless, exhausting cycle. You're working harder just to maintain this image instead of actually living a life you value. So for you listening, this first shift in thinking, it can immediately change how you look at your financial goals. If freedom's the main goal, not showing off, maybe you make totally different choices. Maybe you say no to that high-paying job that just drains your soul. Maybe you work less. Maybe you start that passion project that doesn't pay much yet. Or maybe it's just spending more real time with family without being crushed by financial stress. It's being able to say yes to what actually makes your life richer and no to the stuff that doesn't, without money calling all the shots.
And what's really striking here is this idea of rethinking wealth, this freedom over flash thing. It's not just some, armchair philosophy. It became brutally clear for a lot of people during the 2008 financial crisis.
Yeah, good point.
Before '08, there was this widespread belief, almost unquestioned, that accumulating stuff, big houses, multiple cars, huge investment portfolios, that was security. That was success. So many people are living right on the edge, taking on huge debt for bigger homes, for this lifestyle of, visible consumption.
Keeping up with the Joneses, big time.
Exactly. Then the housing bubble burst, the market tanked, and this palpable fear just gripped everyone. Millions of people who looked wealthy on paper suddenly saw their net worth evaporate. Jobs were disappearing. Their whole sense of security just vanished. It was this harsh collective lesson, about how fragile material wealth can be. People learned that even big, solid-looking assets could shrink incredibly fast. And that real, lasting freedom wasn't necessarily tied to how much stuff you own. It was tied to having a more resilient financial setup, one that allowed you choices even when things went south. It forced this huge reevaluation for an entire generation, really. Focus things back on a strong foundation, savings, minimal debt, things that give you flexibility, not just flash.
And here's where it gets really interesting. Because this isn't just history, it's happening right now. You see it playing out. I mean, take the example from the source, the 2025 India freelancers. But you see echoes of this everywhere, including here in the US. We're seeing the significant trend where gig workers, freelancers, digital nomads, they're actively prioritizing time freedom over maybe acquiring the traditional big house.
Absolutely.
But for a freelancer or anyone in the gig economy, really, time freedom,
Baz.
well, it's everything, isn't it? It means having the power to choose your projects, set your own hours, control your work-life balance, instead of being locked into a demanding 9 to 5 just to cover a massive mortgage that requires constant high earnings.
Right. Golden handcuffs.
Exactly. So this choice shows up in their daily lives. Maybe it's renting a smaller place. Maybe it's choosing a lower cost of living area, even with remote work. Consciously avoiding that huge debt burden, their financial decisions are geared towards building passive income or just having enough savings to ride out slow periods, all so they can keep control over their time, their most valuable asset. So this example, whether it's India or increasingly here in the US, it powerfully reflects that core idea. Choosing freedom over just showing off. They're not chasing the old symbols of success. They're optimizing for autonomy, for flexibility. It proves Collins's idea really resonates, especially with how work is changing.
And moving from that philosophical grounding to the really practical stuff, Chapter 2, Money in Your Life, builds right on this. It's about putting money in its proper place. Collins is really clear. Money isn't the goal itself. It's not your master. It's a tool. A powerful tool, sure, but one that's meant to serve your life, your goals. And he stresses right up front the absolute critical importance of saving more than you earn, consistently. That immediately puts you in a proactive stance with your finances, not just reacting all the time. The chapter uses these relatable examples to really shift your mindset, to see money as something that enables your dreams, not something that dictates your current reality. It's a shift from seeing money as something to just spend, to something you manage strategically to get the life and the freedom you actually want.
Okay, so let's dig into that idea. Money as a servant, not a master. Because that really feels like the core of empowerment here.
It really is. What it means, practically, is that your money, your income, savings, investments should be working for you, actively working towards your goals, aligning with your values, instead of the other way around where you're constantly working for money just to maintain a certain lifestyle or pay off debts that keep piling up.
Yeah, that hamster wheel feeling.
Exactly. When money becomes the master, it dictates your choices. You feel stuck in a job you hate, you stay in stressful situations, you keep putting off your dreams because you're enslaved by the need to keep up with your spending. The danger of letting spending habits run your life is, it's huge. It leads to that treadmill of consumption we talked about. Every raise just gets swallowed by higher expenses. You feel like you're running faster, but getting nowhere.
Right, never getting ahead.
And it often results in chronic debt, tons of stress, and just this feeling of being trapped. No freedom. But just by committing to saving more than you earn, you immediately start taking back control. You empower yourself. And the first steps are actually pretty simple. First, you got to track your spending. Like really track it for a month or two, see where the money's actually going. It can be eye-opening.
Often surprising.
Definitely.
Yeah.
Second, find places to cut back consciously. Not painfully necessarily, but things you don't really value. Maybe it's the daily fancy coffee, maybe unused subscriptions, whatever. And third, crucially, pay yourself first. Allocate a portion of your income to savings before you pay anyone else, before you start spending. It's a deliberate act. You're putting your future self first. That gives you the power to choose your path instead of just reacting to circumstances or, fleeting desires.
Yeah, and this idea of money as a tool and the danger of spending getting out of control, you can really see it play out historically if you look back at, say, the 1990s consumer boom here in the US.
Oh, absolutely.
That whole era, coming out of a recession, there was this surge in prosperity, but also critically, credit became really easy to get. It fundamentally changed spending habits, changed what people thought was normal or even necessary. There was this pervasive message, right? More is better, stuff equals success, and credit, just an easy way to get it now.
Instant gratification culture starting to bloom.
Totally. You had the rise of huge shopping malls, credit card use exploded, they were marketing hard, even to college kids. And the advertising was all about buy now, pay later. Remember all those infomercials? Home equity loans becoming super common.
Yeah, tapping the house like an ATM.
Right. And the long-term consequences were pretty rough for a lot of people's financial health. Many folks just weren't used to having so much credit available, and they racked up huge amounts of high-interest debt.
It trapped them in these payment cycles that just ate away their ability to save or invest or build any real wealth. It kind of normalized living paycheck to paycheck, even for people with decent incomes, because desires always seem to outrun their planning. That idea of money serving you got totally buried under the appeal of instant gratification. Keeping up with the Joneses wasn't just a phrase, it was like the national sport. And the financial hangover was real for a lot of households. Which raises that important question. What can we learn from maybe how a younger generation is approaching this now, especially with the rise of gig work, which has its own flexibilities and, let's be honest, uncertainties? So in 2025, we see this fascinating example, not just in India, as the source mentioned, but really globally, including the US. You see younger folks in the gig economy saving aggressively. Sometimes, like the example says, half their gig income.
Wow, half. That's serious.
It is. And it's such a stark contrast to some past trends that offer some real lessons. What's driving it? Well, partly the nature of gig work itself, right? It often lacks traditional benefits, stability. So maybe that fosters more prudence, a real felt need for a safety net.
Makes sense. Income can be up and down.
Exactly. So you save hard when the money's good. Also, maybe there's a cultural shift happening. More access to financial education online, platforms talking about FIRE, financial independence. But this behavior really illustrates Collins' point. Saving to gain control, not just to impress people. They're not necessarily saving for a fancy car right now. They're prioritizing resilience, flexibility, the ability to call their own shots later. It perfectly mirrors that idea of money serving you. This kind of saving positions them really well for the future, to handle shifts, grab opportunities, and achieve a level of freedom that maybe escapes people caught in the consumption cycle. It's really intentional living in this flexible economy.
All right, so we've hopefully got our heads straight about money, its role as a tool. We're saving diligently now. Where do we put that money so it starts working for us? Chapter 3, the stock market.
Yeah, this is where a lot of people get intimidated.
That's
You see those crazy charts flashing red and green. You hear about traders yelling. It feels like this exclusive, high-risk casino just for experts. But Collins does a really great job, I think, of demystifying it. He presents the stock market not as some speculative gambling den, but simply as the place where you invest in the actual growth of real businesses.
Owning a piece of the action.
Exactly. And he really pushes for a long-term view, cutting through all the daily noise, the ups and downs, see the bigger picture, the powerful, generally upward trend of economic expansion over time. He wants us to see past the scary headlines and understand that owning stocks just means owning a tiny slice of businesses, doing stuff, making things, selling services. And businesses, fundamentally, tend to grow over the long haul because, well, they have to innovate and expand to survive. And the key idea flowing from that is long-term growth. Collins is crystal clear. Patience is everything in stock market investing. The market will go up and down. That's just what it does. It's guaranteed.
Yeah, buckle up.
Right. But by holding steady, resisting that urge to panic and sell when things dip, you let the incredible power of compounding do its thing over years, over decades. Think of it like planting a tree, right? You don't plant a sapling and expect giant apples tomorrow.
No.
Plant it, you water it, you give it sun, and you trust that over many, many years, it'll grow into something strong and fruitful. If you keep digging it up to check the roots or move it every time the weather changes slightly, you'll kill it.
Good analogy.
And it's similar with businesses. Their nature is to innovate, adapt, find new markets, grow, driven by ingenuity, by demand. When you own stock, you're tapping into that fundamental economic engine. Your investment grows as the businesses you own become more valuable. It's about letting time be your friend, letting things grow without constantly messing with them, like that tree eventually giving you a great harvest.
Yeah, and history really backs this up, the importance of staying the course. Remember the 1987 crash? Black Monday?
Oh, yeah. Brutal.
The Dow dropped, like 22, 23% in one day. It wasn't a slow slide. It was a cliff dive, sent shockwaves everywhere. People were terrified.
Total panic. Felt like the end of the world financially for many.
Absolutely. The feeling was, this is it, the next Great Depression. Sell everything now before it goes to zero.
But that event became this huge lesson in not panicking during downturns and the real value of just staying invested. Because the people who held steady, who resisted that gut-wrenching urge to sell into the fear, they actually did really well in the long run.
The market came back.
It did. It's resilient. It recovered over the next months and years. By the end of '87, it was already up significantly from the low. And within just 2 years, it was actually higher than it was before the crash. So those who kept their long-term focus saw their portfolios bounce back and then continue to grow massively over the following decades. The painful lesson for sure, but powerful. Crashes happen, they feel awful, but they're usually temporary bumps on that long road up. Patience wins.
And we see that lesson being applied today, right?
Yeah.
In 2025, the example used is Indian investors holding steady despite a dip in 2024. But that reflects broader behavior we see among savvy investors everywhere, including the U.S.
Exactly.
It's not just random. It shows a growing understanding of these long-term principles. A market dip triggers anxiety. That primal fear of loss kicks in.
Fight or flight.
Right. But seeing investors hold steady signifies this maturity, this understanding that short-term swings are normal. They're part of the deal. They don't necessarily derail your long-term goals if your plan is sound.
It suggests they've absorbed the lessons from '87, from 2008. Downturns can even be opportunities if you have the cash and the nerve, or at least they're not a reason to just bail out in panic. Their decision to hold steady validates Collins' advice. It shows belief in the market's long-term strength and the power of compounding. It's practical wisdom in action. Getting past the emotional reaction to volatility shows this advice isn't just theory. It works in the real world, in different markets. Okay, so building right on that understanding of the market, Chapter 4, Index Funds, gives us the how. The actionable, beautifully simple strategy. Collins is a huge advocate for low-cost, broad market index funds. He often mentions VTSAX, that's the Vanguard Total Stock Market Index Fund, as a prime example, especially for U.S. investors.
Right, the one everyone talks about.
Pretty much. That fund basically tries to mirror the performance of the entire U.S. stock market. So with one investment, you instantly own a tiny piece of thousands of companies across all sectors, super diversified. And crucially, he warns against trying to be a stock picker, trying to beat the market by choosing individual winners. And he really warns against paying high fees to active money managers who, statistically, mostly fail to beat the market after you account for their fees.
Yeah, the fees can be killers.
They really can. The chapter just simplifies investing brilliantly. It highlights consistency, broad diversification, low costs, not complex strategies or trying to time the market. Those are the keys to long-term success. He uses great examples of people who just followed this simple path and did incredibly well.
So let's unpack that a bit more. Why does simple investing beat complex choices? It feels wrong somehow, doesn't it? Like you should have to work harder or be smarter to win at investing.
It does feel counterintuitive. We're often told you need complex strategies, constant research, finding the next big thing. But index funds often outperform active funds over the long haul precisely because they're simple, disciplined, and cheap. First, diversification. Like we said, the VTSAX holds thousands of stocks. You're not betting big on just a few companies. If one company tanks, even a big one, think Enron back in the day.
Right, total collapse.
Yeah. But if you held it through an index fund, your stake was so tiny, your overall portfolio barely flinched. That diversification massively reduces your risk. You're not wiped out by one bad bet.
Okay, that makes sense.
Second, and this is huge, fees. Index funds have way lower fees than actively managed funds. Active funds might charge 1%, maybe 2%, or even more per year. Index funds, often 0.1% or much less. Like VTSAX Admiral shares are incredibly low, around 0.04% last I checked.
Wow, that's a big difference. Seems small, 1% by under 0.1%.
It seems small, but it compounds. Over decades, that difference is devastating to your returns. Think about it. Say you invest $10K a year for 30 years, earn 7% average, no fees. You'd end up with like $1.15 million. Add just a 1% annual fee. That drops your total to maybe $860,000. You lost almost $300,000 just to fees, money that should have been yours. Index funds avoid that drag.
That's staggering, actually.
It really is.
Yeah.
And index funds give you that steady market growth without needing deep analysis or market timing, which even the pros are terrible at consistently. So why is simple so effective? Well, markets are mostly efficient. It's super hard for anyone to consistently pick stocks that beat the average. Plus, our own human behavior often messes us up. Panic selling, chasing hot stocks.
Buying high, selling low.
The classic mistake.
Yeah.
And finally, those fees just relentlessly eat away at returns. So by just mirroring the market at a super low cost, index funds harness the market's natural long-term upward trend. It's powerful, effective, even if it feels too easy.
Yeah, and this approach, it wasn't always the mainstream thing, was it? There's a history here. You mentioned the 70s.
Right. It wasn't an overnight success. Index funds started gaining traction in the 70s, but they were initially met with a lot of skepticism, even ridicule. The market conditions back then kind of paved the way. The 70s had high inflation, slow growth stagflation, and really volatile markets. It was tough for even the best active managers to deliver good returns consistently.
So people started looking for alternatives.
Exactly. The environment really exposed the limitations, the underperformance of many traditional active funds. And during that time, you had pioneers like John Bogle, the founder of Vanguard. He championed this radical idea instead of trying to beat the market, which he thought was mostly a losing game after costs.
Just be the market.
Precisely. His argument was that trying to outperform consistently was a fool's errand, especially once you factored in high fees and trading costs. He passionately argued that a low-cost fund just tracking a broad index would by definition beat most active managers over time, because it eliminates those two huge drags, fees and futile attempts at market timing. People laughed at first. His first index fund was nicknamed Bogle's Folly. But the steady, consistent performance, especially when markets got choppy, slowly won people over. It fundamentally changed investing and made passive investing what it is today, a respected, mainstream strategy.
That's a great story.
And what's cool is how this simple idea continues to resonate globally, like the 2025 example of India investors using mutual funds for steady gains. While VTSAX is US-based, the principle is universal. Indian mutual funds, especially index trackers like those following the Nifty 50 or Sensex, embody that exact same simple investing approach. Investors there, just like here, are increasingly using these tools to get broad market exposure without the guesswork, the high fees, the stress of picking stocks. It shows this deep, worldwide understanding of Collins's core ideas. Investing doesn't have to be complicated to work. Low-cost, diversified investing is recognized globally as a powerful way to build wealth. It shows a growing financial sophistication everywhere, proving this simple path, wisdom, really does transcend borders.
Okay, so we're growing our money, we're investing simply. But what about the stuff that actively works against us? The things that can drag us down? Chapter 5, Debt and Freedom. This is a big one. Collins hits this hard. For so many people, debt just feels normal, unavoidable even.
Yeah, like it's just part of life.
But Collins gives this really strong warning, especially against consumer debt. He emphasizes how it just shackles you, stops you from making progress financially. He doesn't just say avoid it. He frames it like an enemy you need to actively fight with urgency. His advice isn't about being cheap for no reason. It's about living below your means, specifically to avoid these traps.
He wants us to get that debt isn't just the interest payments. It's the cost to your freedom, your peace of mind, your future options. It's like an anchor.
Right. So the key idea, debt weighs you down, and it's crucial to grasp the full weight, isn't it? Not just the dollars and cents.
Absolutely. Financially, high-interest debt, credit cards, personal loans, it's like trying to run uphill carrying weights.
Yeah.
So much of your income just goes to interest, servicing the debt, not even touching the principal sometimes.
Just treading water?
Exactly. Less money for living, for saving, for investing, for enjoying life. Emotionally, it's suffocating. Chronic stress, anxiety, sleepless nights, feeling trapped. It affects everything. Relationships, health, well-being, and opportunity cost. Every dollar spent on interest is a dollar you couldn't invest to grow, couldn't use for education to earn more, couldn't use for an experience you value. It's a direct drain on your future potential.
Collins does make a distinction, though, right, between good debt and bad debt.
Yes, that's important. Good debt is typically debt used to acquire an asset that will likely appreciate or increase your earning potential. A reasonable mortgage on a home you can afford can be good debt. It's often an appreciating asset, offers tax benefits sometimes, provides leverage. Student loans, if they genuinely lead to higher income, can be good debt. These are ideally investments. Bad debt is the nasty stuff. High-interest credit cards used for consumption. Car loans on rapidly depreciating cars. Loans for stuff you don't need that provides no return. These often have terrible interest rates and just bleed you dry.
So what's the actionable advice then? How do you get rid of this bad debt?
Well, the common methods are the debt snowball and the debt avalanche. Snowball. List debt's smallest to largest balance. Pay minimums on all but the smallest. Throw everything extra at the smallest. Once it's gone, take all that money, minimum plus extra, and attack the next smallest. Gives you quick wins, psychological boosts.
Okay, build momentum.
Right. Debt avalanche. List debts, highest interest rate to lowest. Pay minimums on all but the highest interest one. Throw everything extra at that. Mathematically, this saves you the most money over time because you're tackling the most expensive debt first. Whichever you choose, it requires a strict budget, cutting non-essentials ruthlessly, and dedicating every spare cent to killing that debt. Aggressively break those chains.
Yeah, and the historical context for this is pretty stark, too, thinking back to the 2000s credit boom leading up to 2008.
Oh, absolutely. A painful lesson. Credit was so easy to get then. Subprime mortgages for people with shaky credit, credit card limits soaring, really lax lending standards.
The Wild West of lending.
Pretty much. Banks were eager to lend, fueled by the hot housing market. People borrowed heavily, often taking on mortgages they couldn't really afford long term, especially those tricky adjustable rate ones. Borrowed for cars, stuff, without fully grasping the risks and the consequences. Devastating. Massive wave of foreclosures, personal bankruptcies skyrocketed. People lost homes, savings, security.
And it triggered the Great Recession.
Directly contributed. It hit millions of families hard, showed the systemic risk of all that consumer debt and bad lending. A painful, widespread lesson in the true weight of debt when the party stops.
But what's encouraging is seeing how people are maybe applying those lessons now, using new tools, like the example of people using extra side hustle cash to pay down debt. We see that here in the U.S. too, right?
Definitely. It's a really empowering trend. The rise of gig economy side hustles, it gives people this extra income stream. And instead of just viewing that as fun money, more and more people are being really intentional, directing that cash straight at their debts, student loans, credit cards, whatever.
A proactive attack.
It's exactly. It shows this understanding that every extra dollar hitting the principal saves interest and shortens the time until freedom. It's a tangible sign of choosing liberation over instant gratification. Using these new economic opportunities to actively break free from that debt weight Collins warns about. Turning a side hustle into a debt-killing machine. It's powerful. Okay, so once that consumer debt is under control, or ideally gone, Chapter 6, Retirement Accounts, shows us how to really ramp up savings using smart vehicles. Collins breaks down the world of 401ks, IRAs, those things that sound complicated with all the acronyms and rules. He makes them accessible, showing them as powerful tools for long-term wealth building. He cuts through the jargon, basically explains how they work, and shows you how to leverage them strategically for maximum benefit. It's about getting you on a clear path to a secure retirement, using the tax system to your advantage instead of being scared of it.
Right. So the key idea is save with ease, tax smart growth. What are the main benefits here?
Two huge ones: tax advantages and compounding. For traditional accounts, like a traditional 401k or IRA, your contributions are often tax deductible now. Reduces your current taxable income. Then your money grows tax deferred, meaning you don't pay taxes on the gains each year. You only pay taxes when you withdraw in retirement.
Okay. Defer the taxes.
Right. For Roth accounts, like a Roth 401k or Roth IRA, you contribute after-tax money. So no tax break now. But the magic is all your growth and qualified withdrawals in retirement are completely tax-free.
Pay taxes now, never again later.
Basically. The choice also depends on whether you think you're in a higher tax bracket now or will be in retirement. High bracket now. Maybe traditional is better for the upfront deduction. Expect higher income taxes later. Roth looks attractive for tax-free withdrawals. Either way, you get the incredible power of compounding working inside this tax-sheltered environment. Compounding, where your earnings start earning their own returns, it's exponential growth over time. Like that example, $5 a year, age 25 to 65, 7% return. You put in $200, end up with over $1.1 million, start just 10 years later at 35. You put in $150K, but only end up with maybe $540K. You lost over $500,000 just because of those 10 years of lost compounding.
Wow. Time really is money then.
Yeah, it absolutely is, especially here. And setting them up is usually easy. Choose the account, set up automatic contributions from your paycheck or bank. Then it mostly runs itself. Make saving consistent and easy. That's why starting early is so critical. Even small amounts in your 20s can grow massively by retirement, way more than larger amounts started later. This tax-smart growth plus compounding is why these accounts are fundamental for building real long-term wealth.
And this focus on individual accounts like 401ks, that wasn't always the main way people save for retirement in the U.S., was it?
No, not at all. The big shift really happened in the 1980s with the widespread introduction of 401k plans. Before that, many workers relied on traditional pensions defined benefit plans.
Where the company guaranteed you a certain amount in retirement?
It's exactly. The company bore the responsibility and the risk. But things changed, economic pressures, global competition, companies wanting to reduce liabilities. So the 401k, which was initially meant as just a supplemental savings plan, especially for higher earners, kind of morphed into the primary retirement vehicle for most Americans. And that was a huge shift. It put much more responsibility and risk directly onto the individual employee. No more guaranteed pension for most. Now, you had to contribute, you had to choose investments, you had to manage it, or choose simple index funds. It meant people needed to become way more financially literate. It offered flexibility, sure, but also complexity and personal responsibility. It made the kind of clear, simple advice Collins offers even more crucial.
Yeah, makes sense.
And this commitment to using these tax-advantaged accounts, it's not just a U.S. thing. We see it globally.
Oh.
The source mentions Indian workers in 2025 maxing out NPS contributions. The NPS, the national pension system in India, it functions very similarly to our 401ks or IRAs. Government-backed, long-term focus, tax benefits on contributions, tax-deferred growth.
So maxing out means they're putting in the maximum allowed.
Exactly. It shows this deep commitment to their future security. They're not just saving randomly, they're strategically using the best tools available to accelerate wealth building, grabbing every tax advantage possible. It aligns perfectly with Collins's advice. Just like here, when people get serious, they focus on maxing out their 401k, their IRA. It shows that the principles save consistently, use tax advantages are universally understood by people building a secure future, no matter the specific account name or country. It's growing financial savvy worldwide.
Okay, so we've covered mindset, saving, investing simply, crushing debt, using retirement accounts. All these pieces come together in the final chapter, Chapter 7, Financial Independence. This is the payoff, right? The ultimate goal.
This is the summit, yeah. After laying all that groundwork, Collins brings it home. He defines financial independence, FI, as people call it, not as being mega rich or having unlimited spending money. He defines it as having enough invested assets that they can comfortably cover your living expenses indefinitely, giving you the freedom to live life completely on your own terms. It's reaching the point where your money works hard enough that you don't have to work anymore if you choose not to.
Work becomes optional.
Precisely. He introduces the 4% rule as a common guideline to figure out how much you need. And he stresses having a safety net, too, making sure this freedom is sustainable through thick and thin.
Okay, let's dig into that live your way idea and the 25x rule or 4% rule. How does that work?
Like the 4% rule comes from research, like the Trinity study. It basically suggests that if you have invested assets equal to 25 times your annual expenses.
So if you spend $40,000 a year, you need $1 million invested. 40,000 by 25 equals 1,000.
Exactly. If you have that $1 million portfolio, the theory and historical data suggest you can withdraw 4% of it each year. So $40,000 in that example, and have a very high probability of that money lasting for 30 years or even longer, even adjusting for inflation and market ups and downs. It's a guideline, not an ironclad guarantee, but it provides this tangible target for achieving autonomy. It's the math behind being able to quit the rat race, that cycle of working just to pay bills for a life you might not even love.
And FI gives you options beyond just quitting altogether.
Absolutely. You might retire early, like the FIRE movement folks, or you might just switch to work that's more fulfilling but pays less. Maybe you work part-time, maybe start your own thing, without the pressure of needing it to succeed financially right away. You could volunteer, travel, spend way more time with family, pursue hobbies, things traditional jobs often squeeze out.
And beyond the numbers, the feeling, the emotional freedom must be incredible.
Arguably the biggest benefit. It removes that constant pressure of needing the paycheck, the fear of layoffs, the stress of financial insecurity. It gives you the ultimate luxury, control over your time and your choices, power to design a life that actually matches your values and desires, not just dictated by financial need or what society expects, freedom to choose your joy, your purpose, your pace. It's huge. And connecting this to the bigger picture, the FIRE movement, financial independence, retire early, which really took off in the 2010s, it basically amplified Collins's principles on a massive scale.
Yeah, you heard about FIRE everywhere for a while.
Right, and that movement was heavily influenced by people like Collins. It inspired a whole generation, mostly online, to pursue early retirement, sometimes decades early. And their strategies were pure Collins. Save aggressively, like 50%, 70% of income sometimes, live frugally, eliminate debt, invest consistently in low-cost index funds. They tracked everything, optimized saving rates, focused relentlessly on hitting that 25x number based on the 4% rule. It took FI from this niche idea to something widely discussed, actively pursued. It showed Collins' simple path wasn't just theory, it was actionable, achievable, empowered people to take control and redefine retirement.
And seeing people actually do it, living off investments, that makes it real. Like the example of Indian early retirees, but you hear stories from the U.S. FIRE community too.
Exactly. It's not just a few outliers anymore. It's a growing group who successfully implemented these disciplined long-term strategies. It demonstrates that FI is attainable. It shows the 25x rule, the 4% guideline, the simple investing path. It's a proven blueprint for freedom wherever you are. Their lifestyles might vary: travel, hobbies, business, family time, quiet leisure. But the common factor is work is optional. They're living proof that planning, discipline, sticking to that simple path, it lets your money serve you, giving you the ultimate choice in how you spend your days. It really underscores the universal power of these ideas. #tag Outro Darth.
So, What does this all boil down to for you listening today? The simple path to wealth. It's really more than just a book, isn't it? It feels like a blueprint for a life with more freedom. From rethinking what wealth even is, seeing it as freedom, to embracing simple index funds, crushing debt, using those retirement accounts smartly. Collins just lays out this really clear, doable path.
Yeah, the core message is incredibly powerful because it's simple. Prioritize freedom. Save diligently, like you mean it. Invest wisely, patiently. Low-cost index funds are your friend. Get rid of that bad debt, like yesterday. Use the tax-advantaged accounts. It's all about building this solid financial foundation that empowers you. Empowers you to live life on your terms, not someone else's script.
And maybe here's a final thought for you to chew on. If real wealth is about choosing your life, not showing off, what's one small thing, maybe one immediate change you could make today? Something to align your spending or your saving just a little bit more closely with your personal definition of freedom. What really stood out to you from our deep dive today? What action might that spark?
Keep exploring these ideas. Keep learning. Keep asking those big questions about your money and your life. Until next time, stay curious, stay empowered.
And we'll be here, ready for our next deep dive.